Hey everybody, it's Mattia, and we're talking about Chapter 20, Money, Financial Institutions, and the Federal Reserve. So what is money? Money is anything people generally accept as payment for goods and services. This is opposed to barter, which is the direct trading of goods or services for other goods or services. You can think of barter as directly trading, and money as something that replaced barter. Instead of trading for a good when you need to buy something, you used money. The standards for useful money as listed in the textbook are portability, divisibility, stability, durability, and uniqueness. Let's talk about the money supply. The money supply is the amount of money the Federal Reserve makes available for people. And there are three generally accepted classifications or types of money. There's M1, which is money that can be accessed quickly. This is paper money, checks, and coins. All of this money that's currently going around in the system. Then we go to M2, which is everything in M1 plus money that may take a little time to obtain, so money that's in savings accounts and mutual funds, for example. Finally, we have M3, which is everything in M1 and M2 plus big deposits like institutional money market funds. There's a global exchange of money in the world. We have a falling dollar value. This means that the amount of goods and services you can buy with a dollar decreases. And then when the dollar value rises, it's the amount of goods and services you can buy with a dollar increasing. The dollar falls or rises based on the position of the U.S. economy relative to other global economies. The Federal Reserve. The Federal Reserve, informally known as the Fed, is the central banking system of the United States. As we discussed in Chapter 2, the Fed's primary objective is dictating monetary policy for the United States, and there are three main tools which we'll discuss in a minute. But the Fed also buys and sells foreign currencies, regulates various types of credit, supervises banks, and collects data on economic activity. So let's talk about those three main tools of the Fed. There's the reserve requirement. This is the amount that banks must keep in their checking and saving balances physically on hand. So let's say a bank has $10 million in checking and savings balances. This is all the money that people have deposited in their accounts. If the Federal Reserve requirement is at 10%, they have to keep $1 million of that $10 million on hand at all times. It has to be physically in the bank. This is so that if people come and want to take their money out, there's something there for them. The next is open market operations. This is the buying and selling of U.S. government bonds with the intent of manipulating the money supply. Finally, we have the discount rate, which is the interest rate that the Fed charges for loans to U.S. banks. Don't confuse this for the federal funds rate, which is the rate at which banks borrow money from each other. The discount rate is strictly banks borrowing money from the Fed. So we have this chart, and it talks about the effects of the Fed operations, and it might seem a little scary at first, but if you put it in your notes and think about it, it's actually not that hard to understand. And this chart includes all of the things that the Fed can do based on those three tools. So we start with the reserve requirement. The Fed can increase the reserve requirement. This means that banks have less money available to lend to customers. That is because if we increase the reserve requirement, that means that the banks have to hold more cash on hand and they can't lend as much out. The long-term effect of this is the economy slows. The Fed can also decrease the reserve requirement. This means that banks don't have to keep as much cash on hand for their deposit balances, and they have more money available to lend to customers. More money to lend out means more money in the pockets of Americans, so the economy speeds up. So now let's talk about open market operations. The Fed can sell bonds. This means that they are going to sell bonds to various people or institutions, and when they sell those bonds, money leaves the economy. That's because people are purchasing those bonds, so the cash is leaving the economy. Long-term effect, the economy slows. On the opposite, the Fed can buy bonds. This is when they're buying those bonds back. And when they buy those bonds back, there's cash infused into the economy. So money enters the economy and the economy speeds up long term. Finally, discount rate operations. And remember, the discount rate is what the interest rate that banks charge to, or that the Fed charges to banks who want to borrow money, So they can increase the discount rate. This means that it's more expensive for banks to borrow money from the Fed. Therefore, banks borrow less, and there's less money to lend out. Long-term effect, the economy slows. They can decrease the discount rate, which means that now it's more enticing for banks to borrow money from the Fed, and now they have more money to lend out, and the economy speeds up. Finally, let's talk about some different types of lending institutions, and they're going to be all done. There's commercial banks. This is your typical bank: Chase, Bank of America, Wells Fargo, etc. Then there's savings and loan associates. These are organizations that provide typical banking services, but they have a focus on providing home mortgage loans. And for anyone who's seen one of my favorite movies, It's a Wonderful Life, this is what the Bailey Building and Loan was. Credit unions are nonprofit, member-owned institutions that provide a full range of banking services, but they are not designed with making a profit. This is for the people who live in Rochester and maybe even Buffalo now, something like ESL Federal Credit Union. There's certainly certain requirements for becoming a member, and it's generally smaller than a bank, and they're not out to make money. Finally, we have non-banks, which offer banking services, but they do not accept deposits.